Welcome back, Adam here from Go Simple Tax. Today I'm looking at the tax differences between traditional buy-to-let properties and holiday lets. Before we get into it today, don't forget to like the video and subscribe to the channel for more helpful tax content. It is important that I point out that throughout today's video, when I'm referring to holiday lets, I'm generally going to be considering furnished holiday lets, as they tend to enjoy the most tax benefits. There are a number of criteria shown on screen now that you'll need to meet if you want your property to be considered as a furnished holiday let. The main ones will be making it available for letting for 210 days or more in a tax year, which could be by advertising on sites like Airbnb and selecting a minimum of 210 days that people can actually book, and then actually letting on a commercial basis for 105 days. By slipping the word commercial into the definition, it means that you can't include days where you've stayed in the property yourself or where you've let it to friends and family at below market rate. Now let's get started with the first difference that I want to look at, and this is on capital allowances. When you buy any type of investment property, you may well need to kit that property out with things like a fridge, a freezer, washing machine, dishwasher, and even furniture. After all, a well-equipped and well-presented property is likely to generate higher rents. These items, though, are considered to be capital items and would fall under capital allowances for plant and equipment. Capital allowances, in general, are a way that HMRC spread the tax relief on big-ticket items across a number of years. The main writing down allowance, for example, is at a rate of 18%, which means if the property owner spent £10,000 on capital items, then £1,800 of that would be deductible in the first year. There are some specific allowances, such as the annual investment allowance, that might accelerate that tax relief and can even result in 100% of the cost being deductible in year one, but of course conditions apply. For the traditional buy-to-let property, plant and equipment capital allowances are not available. This means that the initial purchase of these items would not be an allowable expense and would not benefit from capital allowances, meaning no tax relief would be available, and when calculating the rental profit figure, the purchase of these capital items would be excluded altogether. By contrast, a furnished holiday let in the eyes of HMRC is more like a trading business, and as a trading business would benefit from plant and equipment capital allowances, which would include the purchase of furniture and white goods for use in the property. This means that the owners of both types of properties are still able to kit the properties out with these items, but it will effectively cost the owner of the furnished holiday let less than the owner of the traditional buy-to-let as a result of the tax relief they're going to receive. There is some good news for the traditional buy-to-let though, as once you've made the initial purchase of capital items, such as furniture, if there was a need to later replace that item, then providing it's replaced like for like with a similar standard of product, then the replacement would be considered a repair or renewal, and these are allowable expenses. The next difference to look at is a big one. It's probably the most well-known difference and the most disliked by property owners. It's financing costs. For most property owners, their financing costs will be their mortgage interest, but just be aware that this can include other methods such as loans. Up until April 2017, the tax treatment between the two property types was pretty much the same, but from 2017 onwards, restrictions were gradually placed on the traditional buy-to-let property owner until we arrived at where we are today, which is that financing costs are not an allowable expense for residential buy-to-lets. Instead, what they get is known as a tax reducer at the basic rate of tax, which is currently 20%. So if the owner spent £10,000 on mortgage interest, then the maximum tax relief they could get in the form of that tax reducer is £2,000. Essentially, what happens is the rental profit is calculated, tax is then applied to that figure at whatever rates of tax the individual pays, and then the tax reducer is deducted from the total. Now, there's a few points to clarify clarify here. First, I said the maximum amount of tax relief would be £2,000 in that scenario, and that's because there are a number of restrictions that apply. Firstly, the tax reduction is actually based on the lower of three things: financing costs relating to the property or properties in question, the property business profits after the use of any brought forward losses, and adjusted total income. This is your income after losses and reliefs that exceed the personal allowance, but excluding savings and dividend income. So whichever is the lower of these three figures is the figure you could get a 20% tax reducer on. So if I had mortgage interest of £10,000, rental profits of £8,000 and adjusted total income of £15,000, then I would be restricted to using £8,000 of my mortgage interest for the tax reducer, and this is why 20% of the financing cost is the maximum tax reducer you can receive. Financing costs also can't be used to create a tax refund. Now, in this situation where I'm not able to utilise the full £10,000 of mortgage interest in a tax year, I do have the option to carry forward any financing costs that remain unused so that I can utilise them in a future year. The situation for furnished holiday lets is slightly different, as mortgage interest and financing costs in general are an allowable expense. They would be deducted from income when calculating the rental profits. Now, of course, this is much easier to administer, but it can also be hugely beneficial for higher and additional rate taxpayers in particular. Because the financing costs are an allowable expense, it essentially means that the taxpayer would be able to achieve tax relief at the highest rate of tax they pay. For example, somebody earning over £150,000 would usually pay the highest rate of income tax, which is 45%. So by claiming mortgage interest, they would reduce the amount of their income that gets taxed at 45%. And this is one of the big reasons why higher and additional rate taxpayers often lean more towards the idea of a furnished holiday let business rather than a traditional buy-to-let. The third difference in the tax treatment between traditional buy-to-lets and furnished holiday lets is the capital gains treatment. When you dispose of any investment property, you'll need to consider whether capital gains are payable. The current rates of capital gains tax are shown on screen. You'll notice that the rates for disposing of residential property are different than those for other assets. Both traditional buy-to-lets and furnished holiday lets are considered residential property for these purposes, so owners should theoretically pay either 18 or 24% capital gains on any profits generated from their disposal, but this is where the difference kicks in. Furnished holiday lets are viewed again more like a trading business and therefore have access to some additional capital gains tax reliefs. These include BADR, which is short for Business Asset Disposal Relief, and means the first £1 million of lifetime gains are taxed at a flat rate of 10%. BARR, or Business Asset Rollover Relief, which allows you to dispose of your property, then roll any gain on disposal into a new qualifying asset, essentially locking that gain away so that you don't have to pay any tax on it until you dispose of the new asset. And gift holdover relief, which would apply if you were to gift the furnished holiday let business to someone, maybe family, and essentially passes any gain on disposal to the recipient of the gift to be dealt with when they later dispose of the asset. None of these capital gains tax reliefs are available when disposing of a traditional buy-to-let property. And the final difference in the tax treatment between traditional buy-to-lets and furnished holiday lets relates to pensions. Again, the benefit lies with the furnished holiday let, as any profits generated from a furnished holiday let business will count as net relevant earnings earnings for pension purposes. This is important when determining how much the individual can pay into their pension within a tax year and still obtain tax relief. Currently, this is set to the higher of £3,600 or 100% of the individual's net relevant earnings. So if you want to make contributions to a pension plan and rental income is making up a large part of your income, then you'll usually be able to make larger contributions if your rental income comes from a furnished holiday let. So there you have 4 differences in the tax treatment between traditional buy-to-lets and furnished holiday lets: capital expenditure, financing costs, capital gains tax reliefs, and net relevant earnings for pension purposes. As it stands, these perks are available until April 2025, at which point most of the tax benefits related to furnished holiday lets will be retracted. That is all for today. Thank you for watching. See you next time.